Hi, hello, welcome to all of you. This is Dr. Manjunathan, Assistant Professor from Department of Commerce and Management Studies, Government First Grade College, Srinivaspur. This session is particularly designed to BBA 5th semester students of Bangalore North University. In this session, we are going to deal with the subject called Investment Management. The topic for the session 35 is Bond Portfolio Management Strategies. Dear students, let us understand the previous class what we discussed. In the previous class, we have discussed about arbitrage pricing theory in detail. The learning objectives of this chapter is to provide an overview of portfolio management strategies, portfolio revision and rebalancing, and apply the various measures for evaluating a portfolio. Once the student attends this particular session, he or she will be able to explain the bond portfolio management strategies. Bond portfolio management strategies can help investors get the most of their portfolio by actively managing fixed income investments to ensure maximum returns. These strategies include interest rate anticipation, sector rotation, and security selection. Bond portfolio management strategies are based on managing fixed income investments in pursuit of a particular objective, usually maximizing return on investment by minimizing risk and managing interest rates. The management of the portfolio can be done by professional investment managers or by investors themselves. Bond portfolio management strategies that involves forecasting interest rates and altering a bond portfolio to take advantage of those forecasts are called interest rate anticipation strategies. Interest rates are the most important factor in the pricing of bonds. The price of a bond is based on its interest rate or yield at any particular time. The most important influence on a bond's yield is the return structure of interest rates. Generally, the market interest rate for any particular term of bond is represented by the yield on government bonds, as these are viewed as highly liquid and of very low default risk. Basic interest rate anticipation strategy involves moving between long-term government bonds and very short-term treasury bills based on a forecast of interest rates over a certain period of time horizon. Since long-term bonds change the most in value for a given change in interest rates, a manager would want to hold long-term bonds when rates are falling. This would provide the maximum increase in price for a portfolio. The reverse is true in a rising interest rate environment. Long-term bonds fall the most in price for a given rise in interest rates, and a manager would want to hold treasury bills. Treasury bills have a very short term duration and do not charge very much in value. Yield curve strategies are more sophisticated interest rate anticipation strategies that takes into account the differences in interest rates for different terms of bonds called the term structure of interest rates. A chart of the interest rates for bonds of different terms is called the yield curve. A yield curve strategy would position a bond portfolio to profit the most from an expected change in the yield curve based on the economic or market forecasts. Sector rotation in bonds. Bond portfolio management strategy based on sector rotation involve varying the weight of different types of bonds held within a portfolio. An investment manager will form an opinion on the valuation of a specific sector of the bond market based on fundamental credit factors, technical factors such as supply and demand, and relative valuations compared to historical norms within that sector. A manager will usually compare her portfolio to the weighing of the benchmark index that she is being compared to on a performance basis. Security selection for bonds. Security selection for bond management involves fundamental and credit analysis and quantitative valuation techniques at the individual security level. Fundamental analysis of a bond considers the nature of the security and the potential cash flow attached to it. Credit analysis evaluates the likelihood that the payments will continue to be made over the bond's term. Modern quantitative techniques use statistical analysis and advanced mathematical techniques to attach values to the cash flow and assess the probabilities inherent in their nature. There are different types of bond management strategies. So we have to understand which are those bond management strategies. Investors in bond may adopt either the passive bond management strategy or active bond management strategy. Both have their own advantages and disadvantages. Under passive management, one can have buy and hold strategy or bond ladder strategy. There are dealt with here separately. One is buy and hold strategy. The investor ignores the expectation of future interest rate changes but select bonds for given income with minimum risk and default free. These investors desire a fixed income and are categorized by themselves. Examples of which can be found among banks, PFs, insurance companies, retired persons, and even pension funds in India. By holding the securities to maturity but reinvesting income at prevailing market rates in similar securities, the portfolio manager maximizes his income. Funds and index tied funds basically follow these strategies to provide diversification, lower cost, and maximize income with the least research base and costs. We have one more strategy, that is bond ladder strategy. The investors under this strategy buys some bonds every year with a given amount with a view to hold different maturities, say 1 to 10 years. The laddering means the bonds of each group of maturity are rungs of the investment's maturity ladder in which investments are made in a well diversified manner. By such regular investments, market fluctuations in price and yields can be earned out and diversified portfolio is secured. If interest rates rise, he will invest in the higher yield bonds from the amount invested in that year. Similarly, if interest rates fall, he will have already some bonds of long maturity to provide capital appreciation. In the Indian context, the public financial institutions, public sector utilities, and government and semi-government bodies are issuing bonds with different features and maturities. The bond investor has to diversify into these securities under both the buy and hold strategy and bond laddering strategy. Under the former, it is a random purchase of all default free bonds with which by law of average may contain all maturities and incorporate bonds of all futures. Here no expectations nor active buying and selling are involved. In the case of laddering strategy also, a fixed amount is used to purchase both of fixed income every year, involving deliberately all maturities and diversification into all types of bonds available in the market, which are default free and with minimum of risk. In the ladder strategy, there is less randomness and more discretion, but is also automatic like the farmer. We have another strategy that is semi-active management strategy. If the investor has time horizon within which investment has to fructify to give an amount of wealth to meet his obligations or liabilities, he has to follow at least a semi-active management strategy. This is necessary because in the actual market, interest rates do change frequently and reinvestments of income from interest will yield lower or higher amount that expected and capital gain or loss will also rise due to interest rate charges. Interest risk has two components, namely price risk and coupon reinvestment risk, which moves in opposite directions. If interest rates decline, for example, the market price of both will go up at the time of payment, but the interim cash flow through coupon interest receipts will be invested at lower rates, which will lead to lower wealth for the investors. The reverse is what happens if interest rates rise in the interim period before maturity. Thus, investors may or may not achieve the desired wealth position at the end of period due to these uh, opposing forces. Elimination of these effects on the bonds portfolio is called immunization discussed that we discussed previously. We have another strategy that is active bond management. Increased volatility of interest rates and disappointing returns in the equity market and growing bond market relative to equity market forced managers of portfolio to involve themselves in active bond management. The major emphasis is to capture the capital gains through bond price charges. As in the case of equity, then the portfolio has to be essentially short term from a few days to few months up to say 1 year. Active bond management is through trading in bonds as we do in equities. This requires major strategy decisions of the type of bonds, maturity and other terms of bonds, their yield, terms, structure of yield and expected shape of the yield curve, etc. As a result of active management, returns can be increased by changes in the maturity structure, coupons, and assets utility. To take advantage of changes in bond price in the daily market and yield pattern, shifting of bonds of low yield and high risk to high yield and low risk from taxable bonds to taxable free bonds, low quality or high quality bonds, etc., is done through ordering, outright purchase or sale, swaps, and recoupons in the market. Bond portfolio management strategies are based on managing fixed income investments in pursuit of a particular objective, usually maximizing returns on investment by minimizing risk and managing interest rates. The management of the portfolio can be done by professional investment managers or by investors themselves. Dear students, let us understand this concept with the multiple choice questions. Number one, bond portfolio management strategies that involve forecasting interest rates and altering a bond portfolio to take advantage of these forecasts are called dash strategies. We have four options. Option A, foreign exchange. Option B, bonds. Option C, fixed assets. Option D, interest rate on anticipation. Any guessing answer? The answer is option D, interest rate anticipation. Another question. Bond portfolio management strategies based on dash involve varying the weight of different types of bonds held within a portfolio. We have four options. Time rotation, option B sector rotation, option C job rotation, option D investment rotation. Any guessing answer? The answer is option B sector rotation. Dash are more sophisticated interest rate anticipation strategies that take into account the differences in interest rates for different terms of bonds called the term structure of interest rates. We have four options. Option A, break-even point. Option B, cost curve. Option C, experience curve strategies. Option D, yield curve strategies. Any guessing answer? The answer is yield curve strategies. We have one more question. The price of a bond is based on its dash or yield at any particular time. Option A, interest rate. Option B, discount rate. Option C, premium. Option D, annuity. The answer is option A, interest rates. Another question. An investment manager will form an opinion on the valuation of a specific sector of the bond market based on fundamental credit factors, technical factors such as dash, and relative valuation compared to historical norms within that sector. We have four options: supply and demand, price and bond, interest and price, securities and risk. Any guessing answer? The answer is the option A, that is supply and demand. Dear students, there are so many books and references are available to understand this bond portfolio management. So I request all of you go through that resources to understand this particular concept. I wish you all the best and thank you for your patience listening. Good luck and thank you one and all.